Hi, and welcome back to Channel 11. I'm Ken Shinoda, your host. Today is Tuesday, November 12th. Well, we have the election. We're looking at a potential red sweep. We're waiting for some congressional races to come in. But let's see how the market's done in October. So the land of gains continues. There was only a brief blip when there was a sad face on the rocket ship going down, but it's really been a pretty tremendous run for equities. I think the stat is 50 new all-time highs this year and just a stellar run for equities, which begs the question, will it continue over the next decade? And maybe bonds are an interesting way to generate returns that are similar in the credit space. We talked about that last Channel 11. So what's happened is as the probability of a Trump win into an actual Trump win has happened, you've seen the Trump trades do really well. Small caps, which would benefit from tax cuts and potential fiscal stimulus to reignite the economy, have been on fire. The financials that would benefit from deregulations have been on fire. The 10-year Treasury yield has gone up pretty dramatically, over 90 basis points from the lows around 360, with fears of more deficit, more growth, more inflation, the need for more term premium in the bond market. And with rates going higher, the dollar has also gone up a lot, seeing big declines, especially relative to the euro. Many calling for the euro and dollar to go back to parity, which would be about a 6-7% decline from current valuations on the euro. Now, looking at equities, everything has done well. The worst performing sector or the worst performing market on this slide is the FTSE, still up 8.6%. But look at the NASDAQ, up almost 30, the S&P approaching 30, up 27% year to date, Russell 2000 up 20%, 9 of that being just in 1 month as that Trump trade kind of playing out. So really strong return for equities, a big rebound in the Mag 7. You can see in the top, the red, that is the Mag 7, the S&P X Mag 7 is in the blue, back to lagging pretty dramatically. You had kind of a reversion in July, August of Mag 7 kind of having a pullback, but just off to the races yet again, leading the charge. You can see the equal weight is actually the worst performer, but it's still up a lot. Looking at some of these relationships, techs versus small caps, it looked from a brief moment that we'd kind of gone above that 2000 level of technologies outperformance versus small caps. We started seeing some reversal of that. Now we're kind of going sideways because both NASDAQ and Russell 2000 have been marching higher. This is now looking at the Infotech Index versus the equal weight Infotech Index, just shows the lack of breadth if this line is moving higher. With that Mag 7 outperformance, you see we've been continuously moving up and to the right, being in that more market value weighted index. The winners keep winning yet again. Now let's look at some of the more speculative parts of the market that have kind of ignited with the Trump election. You can see Bitcoin on the top left. I think it got almost to 90,000 this morning. Dogecoin had done nothing for a while, gone parabolic, and then Cathie Wood's ARK Innovation ETF. It doesn't look as dramatic over this long time frame. If I just showed you a 1-year return, just hockey stick up very recently, and then on the far right, on the bottom right, you can see Tesla. I was supposed to be on Bloomberg last Thursday. I got booted so they could bring in Cathie, but that's okay. She's a USC grad. I went to USC, so got to look out for the alma mater. Commodities kind of weakening very recently, but got a little boost as well with those Trump trades as thoughts of maybe, an economic expansion. But then you look at China, people aren't as confident in their ability to stimulate. And so I think that's part of the weakness. Also, oil prices have come down a decent amount. So that's going to drive this commodity index. Nat gas is also, I think, a big part of the Bloomberg commodity index. So maybe the downward movement to the right a little bit recently is because of those energy parts of the market. And you can kind of see that here. Natty gas down 26% year to date. 5% of that's just this month. Brent crude down 8.2% this month. Crude oil down 8.6%. So energy causing the more recent weakness. Gold has really been the winner. And really precious metals. Everything seems weak except those precious metals in the commodity complex. So rates, we saw a big rally as the market got super dovish. The Fed was going to cut, 75 basis points this year and then another 100 basis points plus next year. We got the 10-year down to 360-ish. We got the 2-year down to about 350. The long bond got all the way down to just inside 4%. And then we've had a pretty dramatic sell-off here as Trump's odds to win ignited a sell-off in the yield curve, a steepening, a term premium priced into the back end. And then very recently, until today, we saw a flattening as maybe there was some hopes of a bond rally with that strong 30-year auction. But yet again, today we're selling off across the curve, but more on the long end. So why is that? Well, expectations of inflation are picking back up. So here we can look at break evens on the left, a pretty big move off the lows, especially in short-term break evens, 2 years break evens being the tips prices reflecting their expectations of inflation over certain time periods, 2, 5, and 10 years. This is pushing real yields back higher. Hasn't hurt stocks yet, but I think if we get back up towards, call it that 470 level on the 10-year, which was the highs earlier this year, I think that starts hurting equities. One of the other reasons that the 10-year yield has been rising is that we've seen some economic surprises to the upside. We look at this every month, City Surprise Index having positive upside surprise, and so rates moving higher with that. Now moving on to credit. Credit has been on a tear. So while rates are rising, so investment grade corporate bond total returns aren't that great. If you hedged out your duration risk, the spreads have been tightening. In fact, both investment grade corporate bonds and high yield corporate bonds are experiencing their post global financial crisis tights. So the up till very recently, the tights on IG spreads were about 80 over. Treasuries, as of last night, we sit at 74 basis points. I think on high yield, it was around 260. We just broke through that, and we're now sub 260 at 256. So spreads on some parts of the market very tight. Other parts of the market still look a little cheap relative value to those asset classes. Doesn't mean that spreads need to widen. Spreads can stay tight for pretty long periods of time. You can see back, go look at that period pre-crisis. Spreads just sat there at that very tight level for years, and so we can see long periods of time with minimal widening in spreads if the economic activity remains strong and people want bonds and fixed income. Big change in the market's expectations of the Fed cuts. And at the September meeting, which was close to the lows in yields, the market thought that we would be at sub 3% on Fed funds at the end of next year. So 286 on Fed funds. We're now pricing in 100 basis points less cuts through the end of next year. And obviously, that could change with data. We'll see how inflation print comes in tomorrow. But if we're only going to get down to a little under 4%, then there needs to be some term premium, which is why the 10-year Treasury is up, approaching 450 yet again. Looking at yield curve and spreads, 2s, 10s, 2s, 30s, we were deeply inverted, the biggest inversion, I think, in 2s, 10s ever, potentially. And we have de-inverted, and now we've kind of flattened a little bit over the last week or so. But, I do think that the curve will continue to steepen either because the Fed cuts and or because the long end's going higher. So we do not like the ultra long end. We are underweight the 30-year in many of our strategies. And, we tend to have a bias towards the front or belly of the curve, which is sold off a lot and looks kind of interesting right now. If you hadn't bought and you missed the rally, month over month, it's been a really strong month. We're seeing a lot of spread tightening as we just saw high yield and IG making new tights. So high yield, for example, 67 basis points tighter on the year. 39 of that was just this last month. Triple B CMBS, which was the laggard last year, with the commercial market healing down almost 400 basis points. 57 of that was just this month. So a lot of spread tightening across the board, except for agencies. Poor agencies just can't win. 8 wider on the month, but still looking cheap. Has been that value trap of fixed income because it's experiencing a lack of buyers with banks and out of the picture. But the banks, as the curve steepens and the Fed cuts, the banks will come back. We've seen them come back a little bit, and we think there's more room to run there. So October was not a good month for fixed income, especially longer duration on the left-hand side. Treasuries down 2.4%, agencies down 2.8%. You can see even the securitized sectors that were fixed rate went down a little bit, somewhere between 50 to 100 basis points. Floating rate, the winner, bank loans up 80 plus basis points or so. So the ag in October down 2.5%, still positive on the year. This is through DEES 31 up about 1.9%. Looking at core plus bond funds, because they own all this other stuff to the left, it's up in the single digits, in some instances double digits. A lot of core bond funds are up around 3-ish. plus or minus, and credit's been the place to be. So if you're in some of our credit strategies, they're still up 7 to 8%. Closed-end funds are up even more than that, low teens. So credit has definitely been the place to be over the last couple of years because they're shorter duration. And while spreads have come in, we still think credit looks really compelling, especially relative to equities that have been on such a tear that at current valuations, it just makes the case for a diversified credit portfolio to be able to potentially outperform equities over the next decade, if past performance is any predictor of future performance, looking at PE ratios. Now, here's the What's Cheap report. It's starting to look weird now because this used to be more spread out. You had, wider spreads in some sectors. You had dots further up. And what happens is, as you see the spread tightening grind, there's a convergence. Everything kind of converges to tight spreads on a historical basis, looking back over 10 years. And then they start playing catch up. So the dots tend to move down and to the left. When these dots are more dispersed, there is more relative value opportunities. It's a great environment for active management. When all these dots sit on top of each other, it becomes tougher to create excess return unless you can put on some great curve trades and time duration better. So we are still overweight securitized credit in many of our strategies. You can see CMBS, RMBS, agencies, ABS, all still further up on this chart. So showing cheap relative value. North of 50 or at 50 is above average, sub 50 is below average. The corporate credit looks extremely rich. It doesn't mean that it's necessarily going to do poorly. It just doesn't have that much potential for spread tightening unless we go tighter than historical averages, which we have now. So US IG and high yield are now 0 percentile. They've basically, we're at the tights. And there's probably a little bit more room to run on some of these securitized credit sectors. Agencies have widened recently. They got as wide as 98th percentile. They had a decent rally last week. They're probably underperforming a little bit today into the sell-off. So still see value in the top left. Again, we own these assets in many of our funds. We're outperforming this year, but this means that we have some more room to run. Should we turn the calendar year, I think those securitized sectors will continue to play their catch-up with the corporate credit market. And I'll leave you again with this chart we looked at last month. This shows you where we are today from a current CAPE ratio, cyclically adjusted PE ratio. We're 30, almost 37. And if you go look out in history, when we're at this CAPE ratio, going back through 1994, the returns are in the low single digits. Goldman Sachs' David Kostin was out with a report looking at similar data. I don't know what his time period looking back was, but basically saying, hey, at these valuation levels, don't look for huge returns based on history. Obviously, things like technological advancement in AI could change things. Corporate tax cuts could perhaps change things and bring in a wave of higher earnings. But just based on history, at these levels, treasuries actually potentially have the potential to generate similar, if not higher, returns after the sell-off than stocks have, given this entry point. And if you go into a basket of credit, you can get 6.5%, 7% diversified. And I think that looks pretty attractive relative to long-run equity returns, which you can kind of see that cluster is around that mid to high single digits. You can get that now in credit. I know spreads are tight in some sectors, but all-in yields are high because base rates have sold off. So we talked about this last month. I thought it was worth mentioning again because stocks have gone even higher. So valuations are even more stretched. But that's it for now. Good luck out there, and hope everyone enjoys the holidays.